In a sense, you have equity investors who are fed up with 1.5 years of no return. You have debt investors who are fed up with marginal rate taxation. And this product, you will attract both.
But debt will be gone in single trade, single day.
What happens when the VIX contracts? What happens if you have a runaway bull market? Does that take a bite out of your returns?
No.
You don't speculate.
Speculation, no. We've seen broadly 9 to 11% kind of annualized returns on a pre-tax basis.
Hello and welcome to The Fine Print. I am joined today by Rishi Kohli, who is CIO at Jio BlackRock AMC at the launch of the Prism SIF. Rishi, is this the moment for SIFs? Has the moment arrived? And if so, why?
I think so. The reason being that the middle between fixed income and equities, the middle space that can be there from a risk return perspective was largely missing in the Indian markets. And instruments that can, or strategies that can take more complex strategies, do long short, etc. That helps you get those differentiated risk return profiles. So since that was largely missing, and now some funds have launched, and many others like ours are launching, I think there is slowly a good receptance in the industry and understanding building up that this can be very attractive from a portfolio perspective, because again, relating it to even recent market conditions over the last 2 years, if you see equities have not done well, even fixed income, most of the times in the last 2 years has been very patchy, very difficult to navigate. Long-term fund managers who have been there, if you ask them, they'll say that you could be a little more medium to long-term earlier. Now you have to be really tactical and do short-term trades, which is not typically their psyche, right? So even that has been very difficult and not easy returns. So that clearly shows the need for something that is absolute return, that can have consistent returns with very low risk, because in periods like this, that can really add value to your portfolio. And of course, these kind of strategies are non-correlated to equity and fixed income. So in any case, when you combine it, you're more efficient on the efficient frontier.
So in a sense, you have equity investors who are fed up with 1.5 years of no return. You have debt investors who are fed up with marginal rate taxation. And this product, you will attract both.
Exactly. Because the goal is, it's largely for investors greater than 12-month holding period, where it is in a hybrid category, and because it's listed, you get the long-term capital gains taxation. So it becomes like arbitrage from a greater than 1 year perspective. But the return expectations is a few percentage points higher than arbitrage on a consistent rolling 12 to 18-month basis.
So essentially, you'll consider an arbitrage plus strategy.
That is largely the goal. And obviously, you'll have many strategies. So we are, as a house, also trying to be as multi-strategy as possible. We are lucky to have many people in the team who come from very different backgrounds, but some people have done derivative strategies, some have done some other equity long short strategies, some have done REITs and InvITs, some have done fixed income. So we've combined all the right talent in the team and mapped the differentiated strategies that could be run given whatever rules SEBI has for the category. And then looked at the cross correlations across these strategies, which also interestingly came to be very low across each other. And finally, we are anyway systematic and quantitative. So that makes us run the process, however complex it may be, very, very seamlessly.
Yeah, I want to drill into that a little bit, because you've pioneered quantitative investing in India. You have the SAE model, and SIF seems to be a very strong fit for that. Perhaps even more so than long only or strictly fundamental driven funds.
Yeah, so SAE to begin with, we are using largely in the callers strategy that we have out of the 4 key strategies in this hybrid SIF. And there, where it helps us is to select the 20 to 30 stocks that we want to write the calls on and buy the puts on. And that is important because, rather than having a random portfolio of just the largest 30 stocks, which sometimes people do, long time back, even I have done that. Or, so pick like the highest dividend yield stocks. That's another way people do it. Or it's just, some other long only portfolios people may have, like the top holdings or the most, positive bets out of those people will take. Rather than that, those kind of approaches, which also obviously we tried to see when we were doing all the simulations, we saw that when we use the SAE approach, and because we're using it in FlexiCap, which is already a 3,200 crore fund running smoothly, when we use that approach, and of course in FlexiCap it is used very, very differently, because we get the alpha scores, then we have risk scores and liquidity and other things. Here we needed it just to select the 20-30 stocks, because then we are going equal weighted, 1% weightage or 1.5% weightage in each of the stocks. So we just needed it to get the names. And there we saw that when based on alpha scores, we are taking like the top 30 names, and every month, then that is actually improving the returns while the risk remains the same compared to all other approaches. So that is why we are using it. And obviously from a practical angle, the comfort we get is that SAE approach is taking all types of data and signals into account. So, we're getting the best of fundamental, technical, flow, analyst sentiment, everything. So that is the fundamental or practical comfort I or the fund managers are getting, that everything is being taken into account. You're not being very narrow in terms of the selection. And then there is at least a method to the madness, which is very sophisticated, which is choosing the stocks. And on an average, stocks remain in the caller's portfolio for 3 to 4 months. Using SAE, we are able to rebalance it monthly, which ties it very well to the monthly derivatives expiry. So that is how all that helps.
Is it safe to say that they'll be largely large cap? You won't be going too much into mid and small?
In callers, yes, largely. But the exact rules we've taken are that we take the FNO universe, obviously, because we are selling options, buying options, which are, whatever
Top
numbers
200,
are, I keep forgetting, but around 200. And then top 100 in terms of liquidity, in terms of options volumes, is then what our starting universe becomes out of that. Because interestingly, if you take stocks or the stock futures, sometimes the most liquid ones there are not the most liquid ones in options. So these are the minor nuances that I've seen live in the last 20 years. So therefore, we are starting with the most 100 liquid options and then drilling down to, like, let's say the top 30 based on SAE scores, and then being 1% equal weighted on it. That is how we are using that. And then, of course, on the overall angle on being systematic or using Aladdin, it all ties in beautifully, because obviously we have Aladdin, which is an end-to-end integrated platform. It helps us in risk management, monitoring the exposure rules, very, very live basis. And I think it's important from an SIF perspective also, right? Because you have little more granular rules now here compared to a long only, because you have the 25% short exposure limits. You have, we have InvITs, you have a 20% cap there. We obviously have much stricter limits internally per name and how the positions go up and down. And therefore, we need to be able to see these things on a live basis and, also see from both investment and risk perspective if something is deviating, which is where Aladdin then comes in. And if there are any spurious correlations across the sub-strategies, because as I said, the whole reason of combining these 4 strategies of callers, merger, arb, REITs, InvITs was that their correlations are very low to each other. But if those correlations are going up in certain periods or something, then Aladdin helps us see those on a live basis and we can make our adjustments. Also the liquidity. So like we know, REITs, InvITs, merger are very interesting strategies. And we've explained how it's very different from what others are doing. But as we know, liquidity matters here, because it's not as if 1,000 crores you want to deploy today, you can deploy in one opportunity. So that liquidity analysis, impact, cost, slippages is the other advantage we have because of BlackRock and Aladdin, because that data is being stored in the BlackRock system for the last 15 years.
Sure. So Rishi, when it comes to risk, the one thing that every investor wants to know, how low can it go? So in your back test, how much drawdown is happening with the strategy?
Yeah, so that is the interesting part, and I'll explain also why that is happening for us, that it is coming to very low numbers. So in the simulations which we've done from Jan 22 to May 26, and of course live right now, the worst peak to trough drawdown using daily data, which is the right way to look at it, because your worst drawdowns could have started from middle of some month and going on to middle of some other month. So it doesn't come up just in the monthly returns. So that worst case has been minus 1.78. So it is really low. So obviously any 1 month, has not seen greater than a 1%. So it has been sub 1%, even in that period. And I think it was in the December 24 to Feb 25 period. And it again started from middle of month, some month, and went to the middle of some other month. And that is why it was minus 1.78. Obviously, worst months and all have been much lower. And
so
even
roughly,
in a...
one can take 1% as the monthly worst drawdown?
Potentially, yes. I mean, there can be certain scenarios where it could also be 1.5. But yeah, it's very difficult to go above 1% given the way it's structured. And even in the live sort of paper portfolio we've been running last 7-8 months, because as I said, different people in the team have done these strategies in their past roles. So we were ready with this model exactly the way we would run it now from September, October onwards. And since the first few hybrid funds were launching at that time and we also were internally clear that we want to launch in the next 5, 6, 8 months. So we started doing a paper track from October onwards so that we have a good benchmarking. So even in that period, March was the worst month for all the SIFs in general and hybrid long shorts also.
March 26th.
Yes, March 26. And there also the paper portfolio shows a minus 61 bips only, which is much, much lower than all others. And the reason for that really at a high level, just if I, in 30 seconds to 60 seconds, I was to summarize, is that we are really eliminating or hedging the tail risk wherever possible. So on the fixed income side, there's no credit risk. On the collars, I'm calling it collars because it's fully hedged. Hedging also via puts is not 6% out of the money puts that many are doing. It is 3% out of the money puts. So it's very, very tight. Merger arbitrage, again has very low 1.5% volatility. REITs, InvITs, a little bit of what we are doing. Out of that, InvITs is much steadier. REITs, has much more volatility. But there also we are restricting the sizes firstly. And secondly, even there we are looking at the beta notionals, beta exposures, and that much of notional exposures of Nifty puts we are buying. So again, we are eliminating the tail risk completely. So as a result of this, we don't have any exposures, that can give us the tail risk or the big drawdowns. Also, finally, we have zero open equity. So, again, most other funds will have something small, even if it's 5-10%. We have zero equity because for us that REIT exposure, since SEBI's classified it as equity now, is our open equity. But as we know, REITs typically as a group, the exposures and the volatility and drawdowns will be 1/3, 1/4 of typical long stocks. So we're really trying to be low risk by construct and by the hedging. And therefore, the beta of our simulations of our live paper track is 0.1. Our annualized volatility on all rolling 1-year periods has been around anywhere between 2 to 3%, so as tight as that. So it's much, much lower than typically what people have seen in the category.
I was going through your presentation, and in the last 1 year, the backtest shows a return of 11%. And the rolling 1-year return is also 11%, which is quite extraordinary for a category of this nature, which is supposed to be low risk. So what is driving that return?
So see, again, the 4 key strategies are very different from each other and each have a reasonably high range of returns. So my collars is targeting 12 to 13% in the long run annualized returns. Merger arbitrage is again in the 12 to 14% zone. REITs is on the lower side, but still 10-11. InvITs is again 12-13. So these are like internal guardrails, internal hurdles, where if the opportunities don't look like they can generate those kind of returns or annual yields, then we wouldn't even get into those opportunities. Having said that, these are the long-term annualized returns. Obviously, as we know, on a rolling 6-month or a rolling 12-month basis, it can vary. There also, what we've tried is with that we've tried to have these models and these opportunities in such a manner and combine them in such a manner that each of them is expected to make a range of 8 to 13. So on the lower end 8, on the higher end 13. Merger up can be 14, 15, but largely 8 to 13. So obviously, if all of them do poorly, then maybe you'll end up at 8, 9, 10. But if all of them do well, then you'll go to that 12, 13% number, which you would have seen in some year in the past as well. So therefore, 11 and 10 and 10.6 is the long-term average that is there. So therefore, 10, 10.5, 11 is anyway the range that we expect in the long run. Lower or higher really depends on whether everything is firing together or not. Because while it is lowly correlated, it doesn't mean it can be non-correlated every day. On a rolling 3-month, 6-month basis is when it will be lowly correlated. But there could be a few months, which are bunched up where everything does well or everything does poorly. The goal is that even then you outperform arbitrage or outperform the liquid fixed income categories. So that even in your worst patch, if you're still 1.5%, 2% better than them, then it becomes very attractive. And in the long run, anyway, the returns are much higher.
Sure. Rishi, one final thing. So, SIFs differ or even the collar strategy differs from long only because of the use of options. What happens when the VIX contracts? What happens if you have a runaway bull market? Does that take a bite out of your returns?
No. So interestingly, the way we've designed it, it doesn't. Because in runaway bull market, sometimes the REITs and InvITs will perform much better as well. So one is, that has some beta, as I said, and which is why we are hedging that beta exposures. But that also helps us, on the upside. And on the collar strategy specifically, what happens is that I'm buying puts and I'm buying much closer to the money than everyone else. So obviously I'm paying a higher cost typically, which means that when my IV dips, then that cost also reduces. And on the call side, I'm not doing a static call selling, right? It is not like, many players are selling at the money calls on all the stocks. Some are doing in the money calls on all the stocks, and some are doing out of the money calls on all the stocks. For us, there is a momentum come volatility model which is running on each stock and deciding whether
Where
to
to
sell
sell.
2% out of the money, 2% in the money, at the money. So that again will sort of, on a blended basis, therefore, that is not really getting affected by the IVs, because the IVs are a small part of the returns. Some part of the return appreciation or alpha increase is happening because of this dynamic rule also. So there, again, I will sometimes get saved because of lower IV, sometimes not. And put side, anyway, the cost will be lower. So on a blended basis, my average net premium I'm paying or net premium I'm collecting is going to be very similar.
Rishi, thank you so much.
Thank you. Great chatting on this.
We are joined now by Arun Ramchandran, who is CIO at Prism SIF, which is powered by Jio BlackRock AMC. Welcome, Arun.
Hi.
Arun, so if you can break down for us the 5 sleeves of this SIF.
Okay, the 5 sleeves which you are going to focus on in this SIF would be collar strategy. That will be the heart of the Prism hybrid long short strategy.
So if you could pause there and explain what a collar strategy is.
Okay. So collar is nothing but if you look at a lot of peers, you're running mostly covered call strategy, where it's nothing but you're long on a stock, you go ahead and write a call against it, and you earn the premium. It generally works if your view on the market is slightly bullish to flattish kind of things. Then what you do is you end up making whatever premium you've earned on writing that call. But here in our strategy, we want to restrict or limit the downside on each of our strategy sleeves which we have here. And hence we've gone a step ahead when we said instead of covered call, we would like to do something which is called a collar strategy. Wherein what we do is, even if the market turns bad or at the script level there are some issues with the script, we protect the downside. We go ahead and take insurance against a falling share price by buying a put.
Right. So essentially,
On
you will
this.
have 20 stocks and they will
Yes.
all be guarded by puts, and you would have sold calls. So they will have to move within the band.
Yes, and the put which we have bought, which we intend to buy, will be at a 3% OTM kind of thing. So any correction at script level beyond 3%, we'll be completely hedged.
And what percentage of the portfolio will be devoted to the collar strategy?
Ideally, it will be close to 50%, could be between 40 to 60%, but we are pretty fluid in terms of allocation to our sleeves depending on market conditions and availability of options. So if we get better opportunities in something like merger up, which is the next sleeve which I was going to talk about, then we might have higher allocation to merger up, we might reduce collar strategy.
Sure. But this is therefore a very large component of the strategy. 50% in ideal conditions is substantial.
This will be the heart of the Jio BlackRock hybrid.
Correct.
Long shot.
And therefore, is it safe to say that you need a broadly trending market, but not too strongly? So you need something that's range bound or maybe slightly positive trending, but not. You don't want a crazy bull market. You don't want a crazy bear market.
Yeah, crazy bear market, again, our downside is protected beyond 3%, as I
Sure.
said. So even if it's crazy bear market, the max loss which we can expect at script level is less than 3%.
Sure.
So that is where we wanted to ensure that the investor knows what's the max drawdown on each of his strategies. So this is our way of kind of communicating to investors that this is what you can expect on a worst day. So even if the stock corrects 10% during the period of the collar
Right.
strategy, your downside on that stock will not go beyond 3%.
Sure. But would you agree with my assessment that it needs to be either range bound or mildly trending upwards?
That is the heart of the
Okay.
covered call strategy,
Okay.
which I said, right?
Okay.
So that is the premise with which you enter these trades.
Sure. Okay. Now the second sleeve.
The second sleeve which we have is something called merger arbitrage. Now that again is a very opportunistic sleeve or strategy. Merger arb is nothing if a company goes and announces acquisition of company B. And the A company is in the futures market. What we do is we short the acquiring company, and we go long on the company, on the target company. We will do this only upon announcement of the official swap ratio. It is not on subject without, it's not based on any
You don't speculate.
speculation. No, it will be only once the swap ratios are announced do we enter this strategy. The benefit of this over something like a covered or collar strategies, these are more long gestation. These certain mergers can take up to 9 to 12 months to consummate, and the prices then to coincide.
But you need both the acquirer and the target company to be in the futures market.
No, we need the acquirer to, because we are shorting the company which is going to acquire, and the target company we are in which way is going long.
Right.
So from that,
You would buy that in the cash market.
yeah. But having said that, the opportunities here, we have seen historically based on our backtesting, there are at any point in time 2 to 3 merger of opportunities available. But yes, we will be actively pursuing these strategies, but again, it should fit into our return expectation.
Sure.
And as I said, the benefit is you get that return over a period of time. So you remove the volatility which a collar strategy might provide,
Yeah.
or a pure play arbitrage might provide, because you don't know what kind of rolls you get next month.
Sure.
So this removes that uncertainty, and you're there, you've locked in that return kind of a thing for a longer period of time.
Sure. Now let's go to the third sleeve.
The third sleeve would be a REIT. REIT is something which we are pretty bullish. We would eventually have a composition in the portfolio which would have at least 10% in REIT on a steady state basis. Now, we do understand challenges with respect to volumes in REITs. That is a challenge which is there in the market. So we don't want to say that at
And
any
this
point
is twofold, right? There are not enough listed REITs, and the ones that are there, there is not enough
volume.
volume in them.
Yeah, and even in the last 2 years since the equity taxation has been imposed on REITs have had a phenomenal run. So end of the day, the dividend yield, if you can put it that way, is not that attractive from a REIT as we speak. Having said that, we would be opportunistically looking at these REITs, and our endeavor is this market will grow in India. We will have more REITs getting listed in this space, and eventually that will be a core composition in the portfolio going forward.
Sure. Okay, so that's the third sleeve.
I'll club it with InvIT. InvIT is our fourth sleeve. Again, similar to REIT, but the volumes are, I mean, even lower when you have InvITs.
Yeah.
They are attractive with respect to the kind of dividends you get there.
Yeah.
Very attractive space. But again, the challenge is if you have a reasonably big fund, the challenge is to get those volumes in place.
Sure.
But yeah, that is something. But this is the universe of our strategy or sleeves, and the endeavor is, as I said, to have allocation to both REIT and InvITs between 10 to 20% on a
Sure.
steady state basis. But we will not be hurrying up just because we've told these are the sleeves.
Sure.
It will be completely opportunistic.
Sure. So Arun, where do special situations fit in all of this?
So that's over and above and extremely opportunistic in nature. We could have entered trades into certain IPO flips if we are comfortable, or certain corporate announcement related trades. But
Okay, so
those
let me
will-
just understand this. IPO flip meaning that you get anchor allotment and then you sell it after the lock-in period. Is that one?
No, we will not be taking that because we are not taking any directional calls in this fund except for IPO. It will be not on anchor, but upon subscription post anchor. If we
Okay.
get any allotments pro rata, we sell it on the day of listing. We are not going to wait for
Okay.
any directional. So there are not going to be no directional calls in the Prism hybrid SIF which we have. Everything is going to be either beta neutral in terms of market risk, but no directional equity exposures whatsoever.
Right. And another example of special situations could be?
It could be some time back we had Tata Motors rights issue. So there were opportunities available during that period. So if we have another one of such opportunities or similar to that, we would consider those opportunities as and when they come up.
So things like buybacks or stock splits.
Yes, it would be. Yes. Now, SEBI mandates 25% minimum debt exposure for hybrid long short category. 25% minimum will be our debt exposure. Here also, where we are going different from a lot of other funds in the market, is we are going to be focused only on AAA in terms of our exposure. We are not going to take any credit risk in the debt portion of our SIF. So,
Right.
We will be actively managing the duration side, but on the credit side, we don't want to expose the investors in this fund to any kind of credit risk, given that the risk reward, it just doesn't favor taking that additional credit risk in a fund like this.
Sure. So if I may put it this way, if AAA bonds today are yielding, say, 7%,
Yeah.
if that's a fair assessment, REITs and InvITs 6%.
Yeah. InvIT is slightly higher, close to double digit, but REITs, yeah, 6.5.
So weighted average of maybe 8% or so.
Yeah.
Really, the heavy lifting has to come from the caller. Is that correct?
Yes, that's why I said that's the heart of the strat. Caller as well as merger up.
Right.
So merger up, if you enter at the right time, we've seen mid double digit kind of returns, 14 to 16% of returns as well in merger up. So if you enter it at the right time, if there are opportunities, then yeah, merger up and callers will have to be the core of the strategy.
Right. And as per your backtest, the returns, is there a rough range that your backtest throw up?
So if we look at our back testing on these strategies which we've run, we've seen 9 to 11% over the last 5 years. That's where it has moved around. In spite of all the volatility which we've seen over the last 5 years, the model has more or less, given the very low correlation between each of these strategies, we've seen broadly 9 to 11% kind of annualized returns on a pre-tax basis.
All right. Thank you so much, Arun. Thanks a lot. I'm joined now by Virendra Kumar, who is fund manager at Prism SIF, powered by Jio BlackRock AMC. Welcome, Virendra.
थैंक यू नील.
वीरेंद्र, तो रिटेल इन्वेस्टर अक्सर समझता है कि अगर हर महीने वो ऑप्शंस लिखे, ऑप्शंस राइटिंग करे, तो इट्स लाइक अ गारंटीड महीने की इनकम अंटिल कुछ फटता है, एंड देन 6 months, 1 year, multiple years of profits can get cancelled out. What is interesting is, for the first time through SIF, institutions can use options to deliver that additional return. तो क्या बता सकते हो कि what is this strategy that you guys will be implementing?
सो या एज यू राइटली मेंशन कि जो अगर आप ऑप्शन राइटिंग करते हो एंड देयर इज अ ह्यूज रिस्क कि अगर स्टॉक आप किसी पर्टिकुलर स्टॉक में अगर आपने ऑप्शन राइटिंग किया हुआ है और स्टॉक अगर 30% 40% डाउन द लाइन नीचे चला जाता है, देन यू माइट बी अर्निंग मे बी लास्ट 1 year 2 year का, बट दैट विल बी गॉन इन सिंगल ट्रेड,
A single day also possible.
single day. So that is the possibility there. But now we have got the opportunity in SIF, जहाँ पे हम लोग properly जो आपका downside है that we can protect, we can control the volatility using the short leg, जो अभी तक हमारे पास म्यूचुअल फंड में कैपेबिलिटी नहीं था. So that we can use for like getting the better risk adjusted return in a way. So जहाँ पे मैं अपना रिस्क कंट्रोल कर सकता हूँ, जहाँ पे मैं अपना ड्रॉ डाउन कंट्रोल कर सकता हूँ. So from that perspective, SIF is very good opportunity.
तो वीरेंद्र, आपका जो कॉलर स्ट्रैटेजी है उसके 3 कंपोनेंट्स है कि आप पहले वो स्टॉक ओन करते हो, फिर आप उसके ऊपर कॉल राइट करते हो, मतलब उसकी अपसाइड थोड़ी कैप हो जाती है, आपको प्रीमियम मिलता है, और फिर आपके उसके ऊपर आप पुट राइट करते हो कि डाउनसाइड भी कंटेन हो जाती है, और इस प्रोसेस में कभी कभी आप नेट इनकम भी कमाते हो. तो कैन यू एक्सप्लेन कि ये कंपोनेंट्स कैसे वर्क होते हैं एंड हाउ डू यू सिलेक्ट कौन से स्टॉक्स होने चाहिए?
So yeah, this collar has 3 legs as we all know. So one will be जो आपका stock है that we'll buy, we'll go long. Other is we are writing the option, call option. So again, that might be sometimes ITM, sometimes ATM, sometimes OTM also. And we are buying the put. So again, the put side we are hedging within the range of 2 to 3%. So मेरा जो maximum possible loss है that will not go beyond 3%. Again, on the positive side, I will not be able to capture full. Maybe if suppose tomorrow the stock moves 10-15%, then I will not be able to capture that 10-15%. But what I will be earning on the upside, so I will be getting some premium, which I am getting from writing the option. Other, suppose I have written the OTM option. तो अगर मैंने suppose 2% दूर का OTM option write किया है, so I will be capturing that 2% plus whatever premium will be there. And on the insurance side, I will be paying जो आपका put का option है, that will be net go from my earnings. How we are doing? So we are selecting top 100 stocks based on the options liquidity from the FNO universe. So FNO universe currently is almost 200 plus. So from 200 plus, we are selecting top 100 stocks based on the options liquidity. And from those top 100s, we are applying the SAE score. So again, the SAE, based on SAE score, we'll be selecting top 30-40 names. And from those 30-40 names, we'll be applying the momentum and volatility based model, which will be suggesting me that these are the top 20-25 names where you have to write the call option. And again, here, interestingly, we are doing very dynamic call selection. So for example, for some particular stock, it might be OTM. Suppose in this particular stock, it will be selling 2% OTM. And in some other stock, it will be selling ATM option. And in some other, maybe C stock, it will be selling ITM option also.
Okay, so just to clarify for our viewers, you can have out of the money, which is that the option is written at a higher price than the stock price, at the money, which is it's written at the stock price, or in the money, which is written lower than the stock price in case of a call option.
Right.
Okay. Does it matter कि market में कितना bullishness है, कितना market की trajectory क्या है? क्योंकि कुछ लोग समझते हैं कि अभी 1.5 साल में कुछ रिटर्न नहीं आया है, अब तो मार्केट भागेगा, तो उस सिनारियो में आप कैसे परफॉर्म करोगे?
So again, I am not taking the directional call here. तो मेरा जो directional performance होगा, that will not be much. I will be participating limited to that. Maybe अगर मैं 2% OTM write कर रहा हूँ, तो I will be catching those 2%. Plus जो भी मेरा call writing से जो option earn कर रहा हूँ, so that will be there. 2% plus that premium in this particular strategy.
2% मतलब per month.
So that 2% is from one expiry to next expiry. So here we are writing the options on monthly expiry.
Okay, but your target return on a monthly basis is slightly lower because you have different components to this. Can you explain a bit more कि month में आपका क्या target return रहेगा?
So from stock perspective, as I highlighted that we will be selecting top 20-25 names, but it will not be it might be, but it will not be the possible scenario that all the 20-25 stocks are up more than 2% in particular month. Okay. So that's why I say that on median basis, my target will be around 1% to earn from the caller's strategy.
Okay. So this is about caller. Now you also have merger arbitrage. Could you explain that?
So in merger arbitrage, so let's take some example. For example, there is company A, which is the bigger company, and it announces that it is targeting for merger for particular company B. So now there will be one price arbitrage between the prices of the company A and the company B. And usually what happens that this merger announcement there is certain process which takes almost 15 to 18 months to complete the procedure. And after the announcement, there will be some swap ratio announcement. So what we do based on the swap ratio dates announcement, then we start tracking and we start building on the positions in the respective swap ratios. So for example, if there is a swap ratio of 3 to 10, then I will be buying or selling the 3 stocks of the company A and 10 stocks of the company B. So when I say that there will be arbitrage and we are trying to capture, so suppose there is company A which are targeted for the company B merger. So I will be taking the short position on the company A and I will be buying the equity of the B. So how I will be taking the short position? I will be shorting the future in the future market. And so there will be price arbitrage which I will be able to realize after maybe 15 or 16 months, whatever period will be there. And in between, I will be earning premium from the short rolling of this future.
Because the futures price has to converge to
Yeah.
the.
So anyway, that is one part. Future price has to convert to the equity, or equity part has to convert to the acquirer company's target price. Price basically.
Okay. Apart from these two, anything else you'd like to add on what you're doing on the F&O side of it?
So generally, whenever some investor thinks about the F&O, there is a lot of risk. कि अगर आप फ्यूचर ऑप्शंस में अगर ट्रेड कर रहे हो तो आपका कितना भी लॉस हो सकता है. प्रॉफिट साइड आल्सो पीपल थिंक्स, बट इन अ वे रिस्क साइड इज
करेक्ट
मोर यूफोरिया. करेक्ट, राइट. सो व्हाट वी आर डूइंग हियर कि एफएनओ के पर्सपेक्टिव से वी आर फुल्ली हेज्ड इन मर्जर आर्बिट्राज आल्सो एंड इन कॉलर्स आल्सो. So from futures and options perspective, we are not taking any directional call. We are fully hedged. We are fully hedged for the tail risk.
Just to finally clarify one thing, so SEBI rules allow you to have 25% naked shorts. क्या आप इसका use करोगे या it's not in the framework?
So this 25% short exposure we are using in the merger arbitrage strategy.
Okay.
So as I explained that this company A, where we have to short the future. So there we'll be taking the short exposure, and there this limit comes into the play. So that's why we have the limit on merger arbitrage that it will be within 25% as a weightage.
Thank you so much, Prism.